Gold and silver derivatives. They're powerful tools that fuel profits for America's biggest banks. But beneath the glitter lies risk, a double-edged sword that could cut deep into U.S. financial stability. Futures, options, and swaps tied to gold and silver have become a pillar of banking operations. They allow institutions to hedge risk, provide liquidity, and of course, speculate. Together, Wall Street giants like J.P. Morgan Chase, Bank of America, Citigroup, and Goldman Sachs hold trillions in derivative exposure. Precious metals alone? More than $5 trillion in notional value. The secret sauce is leverage. With a small investment, banks control enormous positions. It's a recipe for outsized gains, but also outsized losses. When gold or silver prices swing, whether from geopolitical shocks or shifts in industrial demand, the ripple effect can inflate margin calls, strain counterparties, and trigger cascading losses across the system. Traditionally, these trades lived in the paper world, settled with cash, not metal. But today, more investors are demanding physical delivery on exchanges like COMEX. This forces banks to carefully balance their paper contracts with real bullion. If delivery requests outpace supply, banks must scramble to buy gold and silver on the open market, potentially spiking prices and amplifying volatility. Since the 2008 financial crisis, regulators like the OCC and CFTC have tightened oversight, raising capital requirements and setting position limits. But here's the catch. Only a handful of banks dominate the market. That concentration means if even one faces a liquidity crunch or counterparty default, the shock could ripple across the financial system. On their own, precious metals derivatives are unlikely to topple a major bank. Institutions are diversified and backed by Federal Reserve safety nets. But in a wider financial storm, when stocks, bonds, and currencies are all under stress, gold and silver derivatives could act as accelerants, adding fuel to systemic instability. For investors, the lesson is clear. Derivatives may be useful for Wall Street, but they come with hidden vulnerabilities. Physical gold and silver remain a vital hedge, a safeguard against counterparty risk and the dangers of leverage. Gold and silver derivatives enrich banks and fuel liquidity. But they also threaten to destabilize the system when markets turn volatile. The balance between paper claims and physical reality may determine whether these instruments protect the economy or ignite the next financial crisis.
Magi Metals.